Hey there, everyone! Welcome back to our channel. If you're new here, we're all about breaking down complex financial topics into bite-sized, easy-to-understand pieces. Today, we're diving into a subject that affects many of us at some point in our lives, loans and how interest on those loans actually works. So, grab a cup of coffee, get comfy, and let's get started. Now, before we jump into the nitty-gritty, let me ask you this. Have you ever taken out a loan or thought about it? Maybe it was for a car, a home, or even your education. And did you ever wonder why you end up paying more than just the amount you borrowed? Well, that's where interest comes in. Let's break it down together. So, what exactly is interest? Simply put, interest is the cost of borrowing money. It's a fee that lenders charge you for using their funds. When you take out a loan, you're not just paying back the amount you borrowed, but also this fee, which is expressed as a percentage of the loan amount. Let's say you borrow $10,000 for a car loan with an annual interest rate of 5%. What does that mean for you? Well, that 5% is applied to the remaining balance of your loan, and this is where it gets interesting, quite literally. The total interest you'll pay depends on the type of interest, simple interest or compound interest. With simple interest, you pay interest only on the principal amount, which is the initial amount borrowed. For our $10,000 loan at 5% interest over 3 years, the interest calculation would look like this. Interest equals principal times rate times time. So, that's $10,000 times 0.05 by 3, which equals $1,500. In total, you'd pay back $11,500. That's your original loan plus the interest. Now, with compound interest, things get a bit more complicated. This type of interest is calculated on the initial principal and also on the accumulated interest from previous periods. This means you could end up paying a lot more over time. The formula for compound interest is A equals P caret, where A is the amount of money accumulated after n years, including interest, P is the principal amount, R is the annual interest rate, N is the number of times that interest is compounded per year, and T is the time in years. Let's say we have the same $10,000 loan at a 5% interest rate, but this time the interest is compounded annually. Over 3 years, the calculation would look like this. A equals 10,000 caret equals 10,000 caret 3 is equal to 10,000 times 1.157625 equals $11,576.25. That's a total of $1,576.25 in interest instead of just $1,500. See how compounding can add up? Now, if you've ever looked at a loan agreement, you might have encountered something called an amortization schedule. This is a table that details each payment you'll make over the life of the loan, including how much goes toward the principal and how much goes toward interest. In the beginning, a larger portion of your payment goes toward interest, but over time, more of it goes toward paying down the principal. One more thing to consider is the loan term length. The longer the term, the more interest you'll pay overall. For example, a 30-year mortgage generally ends up costing much more in interest than a 15-year mortgage, even if the interest rate is the same. This is because you're extending the time over which the lender can charge you interest. Understanding how interest works is crucial for making informed financial decisions. Whether you're considering a student loan, a mortgage, or any other type of loan, knowing how interest is calculated can save you money in the long run. So, to sum it all up, interest is the cost of borrowing money, and it can be simple or compound. Knowing how these work helps you understand what you'll actually pay back over time. Always read the fine print and don't hesitate to ask your lender questions if anything isn't clear. If you found this video helpful, please give it a thumbs up and share it with someone who might benefit from learning about interest on loans. And don't forget to subscribe for more financial tips and tricks. Until next time, keep learning and stay financially savvy. See you soon.